You draw your resistance level. You wait patiently for days. Price bursts through it perfectly, closing strong on the 15-minute time frame. You feel excellent. You enter the trade. And immediately, the very next candle, the market turns around, drops hard, and takes out your stop loss. Another false breakout. You probably slam your desk. You blame your strategy. Or worse, you start believing the market is rigged against you, that your broker is specifically hunting your stop loss. But here's the truth that separates retail traders, who lose money consistently, from professionals who actually take money out of the market. False breakouts don't exist. Every breakout is a real mathematical break of supply and demand. The reason price reversed wasn't because the breakout was fake or because the market was specifically targeting you. It's because right behind the wall, you just broke through. The opposing side had an even stronger base of limit orders waiting to absorb that buying pressure. The war didn't end. You just hit the second, hidden line of defense. Stop asking, "Is this a false breakout?" Instead, train your eyes to ask, "Is there another structural base right behind this level?" In the next few minutes, I will give you the underlying map to see this hidden order flow war, avoid the deadly retail traps, and actually use false breakouts as your most powerful weapon. To see the market correctly, you must stop looking at single candlesticks and start viewing the chart as a dynamic battlefield of supply and demand. A swing high is not just a peak on an indicator. It is a bear base. It is the exact price level where sellers previously overwhelmed buyers with sheer volume. A swing low is a bull base, where massive buy orders stepped in to defend the territory. When price breaks a level, one side captures a base. But breaking a base is easy. Holding it is the hard part. To know if they can truly hold that new territory, you must learn to read momentum, using nothing but naked price action. Look at the size of the attack. When you see a strong directional wave with large candle bodies, a steep angle, and high volume, understand what that mechanically means. It means buyers are aggressively hitting market orders, and supply is so thin they have to pay higher and higher prices. That is a main attack force. Now contrast that with the pullback. If the pullback consists of tiny candles moving sideways with shrinking volume, that is a weak counterattack. It tells you that even though price is dropping, there is no real selling pressure. The main force is resting, but still in absolute control. Do not trade against them. But what if price hits a major resistance, pushes through slightly, and immediately leaves a massive long wick? That long wick is a violent rejection. In order flow terms, it means the breakout side tried to push, but they slammed into a massive wall of limit sell orders. The defense showed up in overwhelming numbers and absorbed the attack instantly. Never ignore long wicks at key historical levels. A long wick is the market screaming at you that the offensive line is breaking and the tide is turning. Even if you become a master at reading momentum, you will still get chopped to pieces and lose money if you fall into these three context traps. Trap number 1. Chasing parabolic moves. Price rockets up. You see 4 massive, full-bodied green candles in a row. It looks like the strongest trend ever. You feel the FOMO, the fear of missing out, so you buy the breakout at the very top. But look below the breakout point. There is no swing low. There is no structural base supporting that move. When price goes up like an elevator without building horizontal steps, it leaves behind a massive void. When sellers finally step in and take profit, price falls off a cliff. Because there are no buyers waiting below to act as a safety net, there is nothing to stop the free fall. The prettiest, fastest candles are almost always the most dangerous traps. Trap number 2. Higher time frame blindness. Your 15-minute chart shows a beautiful breakout. The momentum looks great, the volume is there, everything aligns perfectly. But if you zoom out to the 4-hour chart, you realize the overall macro trend is aggressively bearish. Your 15-minute breakout is nothing but a minor temporary pullback aiming directly into a major 4-hour resistance supply zone. A small wave cannot stop a waterfall. The higher time frame always controls the order flow. Never trade a lower time frame breakout that is aiming directly into a higher time frame wall. If you simply avoid parabolic chases and check the higher time frame bias, Your win rate will instantly improve. Trap number 3. Chaotic sideways. Sometimes price is not trending at all. It chops up and down violently, whipping through both support and resistance without any clear structure. False breakouts will fire constantly in both directions, trapping both buyers and sellers. This is not accumulation. This is the market telling you it is in a state of complete indecision. Stay out. Wait for a clear directional wave to break free from the chaos before you ever consider trading a breakout. So, if breakouts are so dangerous, when is a breakout actually safe to trade? There are only 2 defensive setups you should ever use to protect your capital. First, the buildup. This is arguably the most powerful and historically proven breakout signal in trading. Price attacks a major resistance level, but instead of getting violently rejected and bouncing away, it stays there. It consolidates tightly, right underneath the resistance ceiling. The vertical range narrows. The volume dries up. This is a coiled spring. Think about what is happening behind the scenes. Sellers at the resistance line are desperately trying to push the price down. But buyers are positioned right below them, quietly absorbing every single sell order without giving up an inch of ground. They are accumulating. Once those sellers run out of ammunition, the supply vanishes. When that spring finally releases, the breakout is explosive because there is no resistance left. Enter the trade when a large momentum candle clears the zone. Your stop loss goes safely right below that tight consolidation, giving you incredible risk to reward. But what if there is no buildup? What if price just explodes through the level out of nowhere and you miss the initial move? The golden rule is, do not chase it. Ever. Use the second setup, the second touch. Patience pays. Let the market come back to you. Wait for the first pullback, a small, weak dip downwards that proves sellers are weak. Or wait for price to come all the way back down to retest the exact broken level. Why does this work? Because old resistance becomes new support as trapped short sellers are forced to buy back their positions to cover their losses. When price touches that old resistance, don't guess. Wait for a long wick pointing down, or a massive green candle to prove that institutional buyers have indeed established a new base. Only then do you strike. Everything we have covered so far has been purely defensive. Now, we go on the offense. Instead of just avoiding false breakouts and being scared of them, what if you could use them as your ultimate high-probability entry trigger? To execute this, you must deeply understand how smart money hunts for liquidity. Retail traders are predictable. They place all their stop losses in the exact same obvious places, tightly below clear support levels or right above equal double highs. To an institutional algorithm, those massive clusters of retail stop losses are nothing but pure liquidity. When banks or large institutions want to accumulate a massive buy position, they face a problem. If they just buy, they will push the price up too fast and get a terrible entry. They need massive amounts of sellers to fill their orders. So what do? They intentionally push the price just briefly below a major support level. Retail traders holding long positions panic and get stopped out, which means their platforms automatically execute sell orders. Simultaneously, eager breakout traders see the support break and they aggressively short the market, creating even more sell orders. This creates a massive flood of selling pressure. Smart money simply sits below the level and passively absorbs every single one of those panicked sell orders. And once the retail selling dries up, the trap is complete. Price snaps back violently in the other direction because all the supply has been absorbed. This is how you trade it. Wait patiently for price to sweep past a key level. If it immediately rejects, leaving a long wick or forming a powerful engulfing candle back inside the safe zone, accompanied by a spike in volume, the trap has been sprung. Enter the trade aggressively in the direction of the rejection. You place your stop loss slightly below the tip of the wick, but give it a tiny buffer to survive a secondary double sweep. You are no longer the prey. You are reading the order flow and you are trading alongside the predators. From this day forward, before you ever trade another breakout, you must run your analysis through this strict 4-question checklist. Question 1. Does the higher time frame trend actually support this move? If you are trying to buy a 15-minute breakout but the 4-hour chart is crashing, you skip it. Question 2. Is there a tight buildup or consolidation right before the break? If yes, the probability of a successful true breakout is vastly higher because supply has been absorbed. Question 3. Is there a massive opposing structural base blocking the path just ahead? If you are breaking out directly into a major resistance level from the past, stay away. The risk isn't worth it. Question 4. If price drops below the level but immediately snaps back up, proving it was a liquidity sweep, can I safely trade the fake out instead and ride the smart money wave? Print those 4 questions out. Stick them to your monitor. Memorize them until they become second nature. False breakouts do not exist. There is no magic, and the market isn't out to get you. There is only a continuous mathematical war between buyers and sellers fighting for liquidity. When you learn to stop looking at patterns blindly and start reading the underlying battlefield, you stop being a victim and you start taking absolute control of your trading. If this video effectively changed the way you view charts and price action, hit the like button, subscribe to the channel, and I will see you in the next masterclass.